If you look at the data since 2010, something like 90% of all variation in US government bonds, to take one example, have come through term premium changes, not through policy rate expectation changes. And this is a dramatic change. If you look through history, it's normally about 50-50. So there's been a real skew to say term premium are important. Now, what are term premium really representing here? They're pretty much representing the excess supply or excess demand for coupon bonds. And what you're seeing in the black line on the chart, which is looking at term premium, is there is a secular increase in the trend of term premium upwards. So you're seeing these term premium in the US continually going up. This is probably a testimony to the fact that issuance is likely to expand. And because of that prospective increase in issuance, investors want some protection or yield cushion against that. In other words, the excess supply of bonds is going to increase, and therefore yields will have to increase. In other words, prices fall to clear the market. And that's pretty much what that's saying.